He is ready. Price, can you hear us?
Hi, Yana, and hello, everybody. Yes, I can hear you fine. I'm just loading up my slides here. 1 second.
Awesome.
See if this comes through loud and clear. See that all right?
Yes.
Okay, you just say the word when we're ready to roll, and we'll get rolling.
We are ready to roll whenever you are.
Oh, I'm always ready, Yana. Well, thank you. I'm glad to be with everybody. Got a great crowd here tonight. Let me see. We've got a volume question. Let me see if my volume needs to be turned up a little bit here. 1 moment here. I'm trying to find the volume control on here. I'll definitely juice it up for you there. How's this? Let's see. Testing 1, 2, 3. Is that a little better? I know sometimes I get a little excited, so I don't want to blast you out on your mic on your end as well. Is A-okay? All right. Excellent. Glad to see you all. We're going to try to cover a lot of ground here in both the stock and the option side of things. I am kind of curious at what kind of an audience we have with us, because it's not just for stock and option traders. What's your main trading vehicle? If you could just type that in the chat box, that lets me know what you're trading, because we can pretty much apply this to anything. We'll take a look. Okay, we've got quite a few futures traders with us, so we'll take a look at the E-minis here, as well as, of course, a lot of what I'll share with you is geared towards options and the overall stock market and individual stocks, but we will take a peek at the E-minis before we're done as well, since it looks like we have quite a few futures traders in with us as well. I've been trading since 1990. I founded Big Trends back in 1999 after doing it as head of research for another big options firm for most of the 90s. And so, we're going to share with you some of the lessons I've learned across my 24 years of trading experience. And, at Big Trends, of course, we put the focus on the trend side. The prior guest had a good point, which is that there are times where the markets trend and there are times where they don't. My belief is that your job, if you want to get the most out of any kind of leverage trading, is to find the windows of time where you have an opportunity for a meaningful trend. It doesn't mean you're always going to catch it exactly right, but it means that if we can find reasonably good entry points, we can stop out trades that aren't working very quickly while letting our winning trades run. And pretty much if you read just about any trading book on success in trading over time, it's about letting your winners run and cutting your losers quickly. So that's what it'll all ultimately boil back to. But for me, I needed a more quantitative way to do that. So I'll share with you some of my specific methods that I use, at least kind of the introduction to that. Now remember, everything that I share with you across these educational webinars is just for that, information and education only. Nothing here should be construed as a specific buy or sell recommendation, because we might be talking about something that we like, but then I won't be around with you to tell you when I'm hopping out of it. So I just want to make sure you're considering this educational only. At Big Trends, we put a lot of our focus on the 3 E's of trading. And you're here for the first big E, which is education. You've got to get yourself pointed, obviously, in the right direction. So you're looking for the right kind of opportunities. I'm sure across your trading experience, you've noticed that as you get more experience, you start seeing the charts in a deeper, richer, more multi-dimensional way, versus when you first started looking at just a basic moving average or other basic trend indicator. But then once you get educated, it's about knowing how to go refine your list, because I don't know about you, but one of the biggest challenges I think that most traders, including myself, face is information overload. You've literally got more than 3,500 optionable stocks and ETFs out there in today's market, not to mention all the futures options that are out there. So the bottom line is, how do you zero it in to ultimately that pinpointed target that then it's ultimately about execution? We want to make sure that after you do all that work, that you can pull the trigger and execute getting in and getting out. And I believe it all starts with having a plan. So I'm laying just a quick overview, but we're going to get into charts and the core principles here in a moment. But, any business that you start, and you have to look at your trading as a business. If you set up a business, what do you have to have? you got to have a light bulb, but the light bulb is a function of an edge, a competitive advantage, something that gives you a way to be taking money out of the markets over time and putting it in your pocket. It doesn't mean, again, every trade's a winner. It means that, yes, you know how to control your losers and you know how to let your winners run, and that over time your system has an advantage. And so our job is to show you, you know, what we believe is some of the best advantages out there in the markets, and starting with a focus on technical analysis. My view is, you know, we'll talk about earnings a little bit here tonight, but my view is that technicals give us a lot more clarity looking at the charts than fundamentals, which are basically up for interpretation. And so how many times have you seen a company beat earnings estimates and then get whacked the next day after that news? So we're going to talk, obviously, Google had earnings tonight. We're going to talk about Google actually with a little options tip I'm going to share with you a little later. But, you know, bottom line is that you know, we want to understand why technicals give us an edge. Obviously, technical analysis has been around for centuries, going back into the Far East and plotting all kinds of agricultural commodities, and then have really exploded with the power of technology with computers. See, computers give me the ability to scan through thousands of different potentials and boil it down to a handful of just a few key opportunities at any point in time. And so that's where we want to focus on, okay, how do we get to the best of the best opportunities? That's why I contend that I don't need to trade mean reverting strategies so much as our prior guest was talking about, because I want to rotate my capital and believe that you should rotate yours to the better opportunities. And if you're not going to buy and hold for a year plus to try to get some kind of a tax advantage in a long-term account, then basically you might as well take advantage of the ability to rotate your capital quickly. And so a big part of the news that's coming out with earnings is not just the news. It's how the markets react to that news. Think about it. What have you seen recently in the government shutdown here in the U.S.? How did the markets react? If you were looking at the overall S&P market, so we'll just look at the spiders for a second, you'll see that, yes, we had I'll just drag this over here on my screen so you can see it. We'll talk about what some of these indicators mean here before we give you an overview, but you can see coming into the government shutdown, 9:30 is where the shutdown happened. We were already getting a little bit of a pullback as people were anticipating that, but at the end of September, the SPY closed right on 168. And basically, as the shutdown began here, you can see that, yes, we were downtrending below the 10-day exponential average there in yellow, but we were still above the longer-term moving averages, and we were making a series of higher lows. You can see that we had not broken, even with this pullback that happened on the 9th and the 8th and the 9th, we were not breaking the lows back from late August. And so you couldn't really grade this as that bearish of a market, but you also weren't quite yet in a new bull mode. But you can see as we got the first whiff of the news a week ago, last Thursday, that Congress was going to propose extending the negotiations on the debt ceiling out at least 6 weeks. Turns out they've worked it out to extend it out longer. Washington sure is a master of kicking the can down the road. They have mastered that, if they haven't mastered much else. And so the bottom line is, as traders, we take note that, hey, it's starting to move out above that short-term moving average. We're starting to get the momentum back. And more importantly, if you're a quick trader, while we were still in a trading range, when we'll talk about our %R and other tools that we like to use, but if you were zooming into, say, an hourly chart, you'll see that the hourly chart, after having been in a series of negative signals from mid-September to early October, gave us a confirmed buy. Let's actually talk about that one for a second, because I know you're eager to dive into charts. And let me share with you one of the first key things I look at. You're probably familiar with Larry Williams's %R, % range indicator, which is the second one down on this panel here, where we can't go into all of them tonight, but you know, that's one that I want you to walk away with something where you can go see what you've been missing. And what %R implies is that, okay, if you move into the top 20% of possible readings, above the 80th percentile in my positive scale, I've kind of flipped the indicator a little bit from what Larry originally had set up, but the bottom line is that that first high, when we first go overbought, when I tell you the word overbought, how many of you think that you should be buying the market versus selling the market? Would you say that all your training tells you overbought means buy or overbought means sell? What would you guess? Well, yeah, most everybody's been trained that overbought by definition implies you should get rid of it, right? Then the theory is that overbought means by definition it's gone too much overbought and therefore it needs to cool off. But while sometimes that's correct, my view is that if an overbought market doesn't indeed top out at that point where it first goes overbought, that tells me that you have something unusual going on. It's called accumulation. It's called buying power, and we all know that the institutions are driving the market. And when you think about it, if you're an institutional investor and you see the market going up and then keep going up, and if you've got too much cash, you're sitting here saying, hold on, I'm lagging the index if I sit here in cash as the market keeps surging up. So as we break out above that overbought high about 3 bars later right here on an hourly chart, this is a 60-minute chart pulled off a TradeStation here through today's close. And the bottom line is that was telling me that something unusual is going on as it closes above that 168.5 zone at 169.04 back on the 10th. You say, but we still have all these uncertainties overhanging us about the government shutdown, the debt ceiling, all these things are still hanging. That debt ceiling day was today, the 17th. So you're a week out from that. But the point is that the buying is already happening well in front of that. And you see what the overbought nature as we stay in that red line there, and we only get one little test, which I call a retest, that came in, you can see back here earlier in the week on Tuesday's last closing bar there. You can see that low was a key low in my work. That's what I call a retest. If that low is taken out going forward in a future close, that's going to break down this trend, and that was at 169.69. Instead, you see what happened yesterday morning, we gapped up. And so we're off to the races again. So how is it that this thing can stay in the top 20% of readings here between the 80% and 100% readings? Remember, 100% means you're closing at the absolute high of the range, looking back, in this case, over the last 30 bars of action, about the last 4 days of action on an hourly chart. Because it keeps making higher and higher highs. That's stretching your range higher and higher, and of course, the low end of your range is essentially ratcheting up too because you're losing this old data back here. If you looked at the current action right now, you'd literally be coming back 1, 2, 3, 4, about to that point. So the low of that range is back here the morning of the 14th at 169.08. You've lost this older low data. So we're staying in a tight up channel and closing near the high of the range. That's bullish. That's an uptrending pattern. And you can see that's been a very favorable thing for the market ever since that buy signal there on the 10th. Now you can convert this into options. We're going to talk about option charts too, but if you were just doing something really simple, like say you were back here on the 10th wanting to buy a relatively more conservative option, it's all relative, right? There's risk in everything. But say you bought an option that's say, even 4 points in the money. We'll be really conservative looking at, say, a 165 call out to the October expiration and saying, well, if I was just looking at what did that do over that same period, because we've gone from 169 to 173, well, look at that call option has gone from about $4.54, and today closed at just about $8.49, bid $8.21. So not quite a double, but you can see that basically the power of this over a week's worth of action, while this thing, again, the option chart, as I will tell you about a little bit, has shown a very similar profile. It's one of the reasons that I like to trade the more conservative in-the-money options when you're just getting started learning the big trends method, because it'll very much simulate what's going on with the underlying stock or underlying market in this case. Okay, so that's a quick overview of what we're doing there. And so the point is that those trends are what we're looking for. That's where the growth potential is for any security, and of course for the option on that security if you're buying the option. It doesn't mean that you couldn't go ahead and sell a put instead of buying a call if you're bullish like that chart showed you, but it means that, as you learn your strategies, you'll learn when you want to take a little bit more risk or when you want to take a little bit less risk relative to your own risk reward profile. Now, from the perspective of what else we're trying to manage is we're trying to manage our emotions to not get too high or too low. See, most people out there in the markets are in this what I would call manic depressive state. They're oscillating between fear and greed so often that it's literally like you could have a neck brace for how many times your neck snap from optimism to pessimism to optimism to pessimism, like a bobblehead doll, right? I mean, basically, you have to get out of that cycle of emotionality towards the markets. We all deal with it. One of my big lessons learned from the times when I ran my equity up and in my early days ran it back down too quickly because I had too much capital committed to any one idea. So one of the first ways that you need to learn how you manage your emotions is learning how you manage your trading capital. One of the big lessons here is you don't want to overcommit your capital to any one idea. I don't care how confident, how much research, how many great different things you think are lined up where you think you should load the boat. I'm suggesting to you, don't do it. Be consistent and be conservative in how you manage your capital. So, for example, even if you put in 5% of your capital into a trade, and you might say, well, then I'll take a 20% stop loss. That'll keep my risk at about 1% of my trading portfolio in that particular example. But what happens if you get a big gap against you? Then you might be exposed to more than that 1% total portfolio risk. So you've got to think about those worst case scenarios and really manage it appropriately. And that's why we focus on taking partial profits along the way too while we tighten our stops. Now, from this perspective, a few key things you got to remember about the markets. Just like the chart I just showed you, the markets have been discounting that Congress and the president, everybody would work it out at the 11th hour because they've proved that to us, haven't they? That they're really good at working things out at the 11th hour to the point that the market practically yawned when the government shutdown happened starting off the beginning of October. Because it's like we've been through this, we've seen this story before. It's like the sequel of the sequel. And you know how it's going to end pretty much, is that they're going to work it out and kick the can down the road. And so the markets discount that well in front of today's news. And the point is that, of course, these price action developments do tend to become self-fulfilling. They tend to feed on themselves, partly because of what I mentioned to you about how institutional and other investors are going to see an uptrend and they're going to say, I want a part of that too. And so you get this pile-on effect that happens at some degree. Some of them are stronger than others. We'll talk about some of the other confirmation tools that I look for to tell me that indeed it's not just a one indicator type of a move, but actually we get multiple points of confirmation along the way. But you've probably learned it's very hard to pick tops and pick bottoms. It's very hard to call out reversals. It looks good in retrospect. I remember John Bollinger saying at a conference one time, he said that his mentor told him that you're only allowed to call the exact top and bottom of a market or any market once in your trading career. And that's a pretty humbling thing when you've got, one of the legends out there, John Bollinger, talking about that you don't try to pick tops and bottoms. You'd even think with Bollinger Bands that that's the point of them, but actually we use them to help us validate when you have good trend moves starting to develop. And then the third key point is that the past will tend to be repeated in the future. It's just that the names will change. We all know that Microsoft and Cisco and those names that were the big tech bubble names in the late 90s that helped me to found Big Trends, that I did so well riding the tech bubble and getting out before it completely collapsed there in 2000, that those names have been dead money for quite a long time, right? But in the meantime, you've had names like Tesla come in, so that while Qualcomm wasn't going to do what it did in '99 anytime soon because it became such a bigger stock, in comparison, when you look at a stock chart like Tesla and you say, well, okay, this is obviously a bubble, but our indicators are designed to pick up and trade these bubbles. And you can see, look at the launch point as Tesla broke out, not just in the percent R back here, confirmed at just a couple cents under $48 back in April 19th, and we've had a couple of other percent R signals since, which we're now out of on TSLA. That's the really been the hot stock of 2013 when you talk about really magnified movements over relatively short periods of time. But then we back that up with tools like the Commodity Channel Index, looking for breakouts there. The ADX, a strong directional trend that you saw in that first wave up, April and May, caught really that more parabolic. You can almost see it going vertical. And there's my, in the purple lines on top are my acceleration bands. That was the biggest acceleration phase for Tesla shares. It's still going up, but at a slower rate than it was going up back there in April and May, obviously. Obviously, all trees can't grow to the sky forever. But the point is that, okay, right now it's in that no man's land on the percent R. It gave our last exit here at this closeout here at 176. And while it's a little bit above there right now, it's still basically in a trading range. So we want to stay away from trading ranges and really only trade the trends. So from that perspective, you look back at other stocks that have shown the same kind of a profile. And what you'll notice as a pattern when you talk about the equity side is that they're growth-oriented names. And they're oftentimes names that have a little bit of controversy. You know, like you'll get some short sellers involved, like on a Netflix or a LinkedIn or something like that, Facebook, you know, but also like the growth stocks like in the growth areas like gaming. Las Vegas Sands and Wynn Resorts would be a couple that would be very classic examples. And what you see on this chart is going back in time, Las Vegas Sands broke out on the very left side of the chart, and you can see there's our breakout. This is pulled off a Metastock, but we can use multiple trading platforms to do this. And you can see it's backed up by not only the breakout on the percent R, but also the CCI moving into its overbought area, and then the break above the acceleration bands. And you see that's a really strong signal, that especially the first leg of that as it stays outside those bands gets a good little lift. This next signal wasn't as good because you can see that while it did indeed break out here, it was not outside the acceleration bands back there in June. So that doesn't have all of the different indicators working in its favor. And of course, where does the real launch point happen? You see that the real launch point happens on this one as it moves outside of those acceleration bands in a big way on the far right side of the chart. Now, those moves will oftentimes scare a lot of traders, so they say, oh, that's just way too overdone. But the point is, like a Tesla, these moves can be very dramatic and very dramatic price action in very compressed periods of time. See, if you're an option buyer, you want maximum trend in the least amount of time possible to really leverage this this whole concept. JPS, on what platforms will my big trends indicators work? We've got them across a lot of different platforms now, including Thinkorswim has them, now part of TD Ameritrade. Options Express has a variety of the indicators. Trade Monster, a lot of the big broker platforms have that. And then, of course, you know, some of the other charting providers like TradeStation as well as Metastock in this example, just to name a few. So our view is that technical analysis, you may think that a company has just, the stock has gone way too far to the upside, and we don't believe that that fundamental value criteria is really good for active traders. That what it'll do is, if you think a stock is too expensive, is it'll keep you off of great companies and basically make you miss some of the biggest and best trends in the market. So we want to just boil it down to price and volume trends. Where is the supply and demand coming in to tell us when we're getting another one of these patterns that's likely to repeat itself? Even though the names change, the pattern tends to remain the same. And why is that? It's because human emotions and human behavior doesn't change. We all have better technology at our fingertips. We have more faster internet connections. We have more choices. And I think a lot of us are better educated than we've ever been in understanding how to take advantage of this. But you still deal with the old emotions of fear and greed, and making sure you can manage that to help us better stay with future trend moves as we go. Now, I've alluded to that we need to improve our consistency by really focusing on how to minimize our whipsaws and minimize those fake outs, and really allow ourselves to just have the patience to wait for what would be more of a true breakout. And so to me, you're going to see that I will never catch a trend right off of a first little initial move, because I'm looking for that little bit of extra confirmation, because if I get it, I'm likely to have a lot more confidence in that trade. And if I don't get it, I'm likely to miss some of those whipsaws and fake outs that'll really help you. Now, and just as an aside, how many times have you felt like the markets are just waiting for you to pull the trigger to get into the trade, and as soon as you hit the buy button, click, then the markets go the other way? Do you ever feel like that, that sometimes it's like a conspiracy against you? Yes, we've all felt that way, Al, Matthew, Taz, of course. You know, but the point is that what I'm looking for is making sure I'm not with that first batch of traders that tends to get faked out, but rather getting that confirmation move, because when I send a trade out to my subscribers or when I'm teaching traders how I trade, looking over my shoulder, I'm saying, look, waiting for that confirmation, then starting to gradually build your position will be a much more effective approach than kind of going all in, going with that heavy-duty rush of a bunch of capital all at once. You know, a good trend should have some staying power, should have some legs to it. And so, and then, as Nilesh mentioned, yes, then you're stuck, and then you struggle to get out. And that's where the psychology of good trading, if you get an exit signal, first rule of thumb is exit first and ask questions later, okay? Even if you get a quick whipsaw and you get in and you have to take a quick loss and your system says get out, okay? Don't get stuck holding on to a trade that's not in an active buy signal. But what we're looking for is, when do we get that, what I call setup, that first kind of the stock starts to raise its hand that, yes, I might be interested in moving here, but then that confirmation, that follow through that tells you that, yes, the institutions who you and I know are driving the market want on board this thing. They're continuing to acquire it. Let's face it, if you're an institutional money manager and you get a sign that you want to buy this stock, do you think you can buy all of your position in one day, especially if you're a big one like Fidelity or Vanguard or one of the big boys and girls? No. You're going to have to buy that a lot of times over a series of not just days, but often weeks to build your position. You know, that you cannot be the 800-pound gorilla in the room and expect to just jump in the pool all at once and splash all the water out of the pool, because there'll be nothing left. You know, there'll be no more opportunity there. And so the point is that you've got to ease in if you're an institution and gradually build your exposure. And that's why these trends, I believe, become persistent trends. So the setup is where you're looking for, you know, that first breakout, and then you don't want to buy or trade right into that setup, because you need to see that confirmation, that follow through. A good trend will show you that as you get that follow through confirmation, that basically you'll see new opportunity come from there. Now, so I know a lot of you asked me about Apple as an example of a stock that everybody's always wondering how's Apple doing, right? And Apple actually shows us that it just gave a new confirmation point just the other day. Okay, so if you're looking at Apple here on the daily chart, and you see Apple had really been dead money for quite a while. If you go back and look at the prior 6 to 12 months, going back to the top that happened last September right on the iPhone 5 launch, that's why I would say be careful about news, because that was already understood and factored in. And then look, we started to get sell signal, sell signal, sell signal as it came down from the 600s down into the 400s, right? So now it's recovered back to just over 500. And look at our percent R, which gave at least the starting point. We actually don't have all of the indicators confirming just yet on this particular example, but Apple back on the 14th did give that first little, what I call setup. It's starting to raise its hand and say, I'm going over bought here with a high at 497.5. And you see what happened then on Tuesday's close. We closed above that at 498.68. So that's a point above that point at the close. Tells us that the bulls are now starting to win the war. And so that gave us a bull confirmation to buy it at yesterday's open, right about $500.79. Now, you see what happened today? It opened lower initially, just a hair under 500, but it quickly flipped up and finished 506.70, up about $5.50 on the day. We don't have the ADX and the CCI quite yet confirming. They're getting close. But so what I would do in this kind of a case is I would just start to tiptoe into the position and start to build just a little bit. So let's say that you were normally going to apply whatever your allocation method is. Let's say you're going to apply 5% of your capital to this trade. If I've only got one of these indicators working so far, I might only take maybe 20% of that capital, maybe 1% out of the 5, you know, so you start to build a little position in Apple. Not all of your trades have to be loaded to the hilt right away as soon as you see that percent R buy signal. So the point is that when you see this, you're saying, okay, yes, you might be looking at some old resistance. I'm looking at my acceleration bands have not been broken. CCI needs to confirm. A few other things need to happen to get that all heavier allocation working. But you can always start to gradually build your exposure. And my stop on this one is down at 489. If it closes under 489, that's the first setup point. that would be a violation. That's about a 16-point stop, or about 3% on the stock. That's a bit wide, at least for you quick traders out there. If you want to look for shorter term signals, you would go in and look at an hourly chart and see that we've been on an hourly buy signal for Apple back since 490, up about 15 points, 16 points so far. So the bottom line here is that, whatever time frame you trade, whether you're a day trader, a swing trader, or more of an intermediate position trader out about 2 to 4 weeks, you can fit this method to your time frame and get that follow-through confirmation to build your confidence in the trades. Now, it's not just for bulls, it works for bear trades as well. I always think it's interesting when we talk about Apple. One stock that got left behind is Research in Motion, the maker of the BlackBerry, right? BlackBerry was the dominant player back, going back about a decade ago. They were in the lead, right? But you can see going back here a couple of years back, they lost that lead as Apple and Samsung and others started to cut into it with more innovative smartphone offerings. And so the reality is that Research in Motion, the old RIMM, is now ticker symbol BBRY. But you can see we got two sell signals on this chart, and this is another important point. This chart shows you that the first signal was not where the money was. It doesn't always work this way, but it means that you must be consistent in taking each signal, and that's why I would rather see you take each signal on a smaller level than load up on the first signal, which you can see sell signal happens here at about $50. It edges, actually about 53. It edges down to about $50, and then this one stops you out back here right about the entry point, about 53.5. But then the next signal, when it gaps down on a disappointing earnings report at the end of April, look, it gaps down and then it follows here. It breaks that first low here at the start of May. And look, we continue to trend down. We came close to what we would call a retest point back here on this one-day bounce in mid-May. We did get a retest point back on this next bounce in late June, and that retest point means that you don't want to see it close above that high from June the 23rd at any point going forward. It doesn't, and we get another retest point. What are retests? Retests are not just a place to reset your stop, but guess what? How many times have you ever had the experience where you were right on an idea and then you missed that first leg or even that second leg of a move, and you're looking back going, gee, I should be short, or I should be in puts on RIM from back in the mid to upper 40s. Now it's at 30. Boy, I feel dumb. Well, guess what? The reality is that it's happened to all of us. This is another opportunity where you could say, hey, you could even take this as a quick trade back to the downside after a retest. After each of these points where we get that test point up, it'll happen on a bounce in a downtrend, but those are spots where you could actually re-enter a position at a very manageable risk, because you know that if you're wrong and it violates that next test level, so let's say that you took this next one here that's going to end up being the final exit. There's a time where you took that one there at $25 and you say, well, gee, it stops you out 2 days later when it pops up and closes above that key resistance. So that would be a loss after several prior wins on the prior retest. So the point is that don't be a perfectionist and think that you've got to just get that initial point back in early May, and if you miss it, I've blown it, I'm out, I can't take any more trades. No, this is where the retest method that we teach at Big Trends really helps you to hop back on board. So now, percent R is not the only thing that we look at here. The percent range indicator is certainly important. And my view is I don't have to develop every indicator. If I see a good idea like John Bollinger's Bollinger Bands, I'm going to figure out a way to use a good indicator and a good idea if it tests well. And it's got to go through a series of testing here at Big Trends to say that there's an edge that's worth following. There's a lot of things I've looked at over the years that sounded good on the surface, but then when you actually put them through the testing, didn't create an edge or actually had a negative result where they actually were costing you money. And that's the idea of, any form of investing. It's got to have a positive expectation for you to want to sit and continue to play that game. Let's face it, when you go to Las Vegas and you're sitting down at the table, they want you to sit at that table as long as possible. That's why they give you those little reward cards that you can plug in and encourage you to sit and play for long periods of time, because they know, the house knows, the longer you play their game, the more their edge will be played out. They don't want you to plop it all down on one hand and if you win, take the money and run, right? They want you to gradually play their positive expectation game, which for you is a negative expectation game. And many people call it entertainment. I don't find it entertaining at all to lose money. Okay, so the bottom line is that I don't want to sit at those table games in Vegas because I know that's a disadvantage to me. I want to find games where I have an advantage. The stock market gives you many different ways to take advantage of this in a positive way, including my acceleration bands, a number of other tools, some of which you've heard of like MACD, some of which you haven't heard of like the efficiency ratio. A guy named Perry Kaufman, saw him talk back in the 90s about the idea of trend efficiency and then converted it into an indicator that people can use. And then percent R, I put a lot of energy in all of my key trading techniques. So here's another example. I'm going to show you the prior example with Netflix and now the current chart of Netflix here after this. But this is going back when Netflix is breaking down. Remember, they took a pretty controversial step when they said, okay, they were going to move a lot of business out of their DVD mailings into streaming media. And at the time, that was considered to be a bit of a negative thing at first because it looked like that they were going to really hurt their profitability there. So obviously, the market has since rebounded sharply. The stock's back to $332 at today's close. But you can see on this example, here's where you get a couple of quick stop outs for they'd be losing trades back there in August on this chart. And then you see where the big winner hits here. Here's another example where, hey, if you find one of these, it's breaking down, and then it really breaks down under the acceleration bands for 2 straight closes. This one happened at about $160 on its way to getting cut in half from mid-September to late October, looking back at a prior year. And you can see if I get a gap like this one, gap down to $80, they're literally a couple of years ago from where we're talking right now. This is a good example where any gap that you get a big gap in your favor, you should be booking at least partial profits on your position. I don't care how bad the news was. You can see what happened. It then stabilized and started to recover from that. Now, if we look at, that was a sell signal. If we look at Netflix more recently, for example, on the daily chart, this year it's been, you can see, all but one buy signal, and the sell signal I wouldn't take because it's above the long-term moving averages. That's why we look at those long-term trend lines. You can see the last signal alone. If you missed all those other moves on Netflix, well, guess what? There's your buy signal. When Netflix goes overbought here and then follows through, it's buying at about $273. If you miss that first move, you get a retest right back there at $274.50 back there in late August. If you missed that one, you got another retest coming in here September 17th, $297. Now, let me talk about that for a second. If you missed the first retest at $274.50, you say, well, now you want me to buy on the next retest here at $297. How do you know that's going to hold? And my response is, A, any one retest may or may not hold, but you know on a risk-reward basis, if you catch it right off of a retest, you can really get a lot more upside relative to very manageable risk. But the other point is, any uptrend is defined by what? Higher highs as well as what? Higher lows. So you want to see your next retest be at a higher level than your last one. That's called an uptrending structure. If this was giving me a retest down on a shot down here below that prior low, that would not be an uptrending structure anymore, would it? So you should actually relish the thought that, okay, each of these retest points, the next one here at 299.5, gives you a spot to get back on board the horse, on board this proven uptrend. Now you can see when this next one violates, it's going to violate kind of sharply here, 318, and the violation happens the next day at 302. So that one cost you 16 points compared to the prior ones where you were popping it for about 25 points on that one, about another 20 points on this one, and then the final one here that popped it from 299 up to about 320, about 21 points. So that last one was kind of painful, even though it was only in and out for a day. That's just part of the reality of trading. What about right now? You can see we tried to go overbought at the start of the week, and then it failed, and now we're trying to go overbought again. I would actually wait and see if it can close above today's high, which is 330.21. We're above it after hours, but it matters what happens at the close. Just giving you some very specific tastes of what you might now be able to see a little differently with how the market reacts. Now, yes, Carl Icahn bought into Netflix. He's bought into Apple. You can play that game of like what Carl says or what Warren says or what anybody says, but the reality is the chart tells you much more clearly where the money's going. Is it going into the stock? Is it coming out of the stock? That will make your job a lot easier to be an objective reader of what does a chart say. Don't get into what you believe, get into what you see on the chart, okay? So now let's talk options for a couple minutes, because for me, I've always been attracted to the power of options because of their ability to take a good trend idea and now leverage it. Now, you've probably heard of the options Greeks. The Greeks are some of the terms in the options pricing model that show you what your option is likely to do. So, for example, when we say the word delta, delta means how much your option is going to change when you get a 1-point move in the stock in your favor. So, if I've got a stock at 100 and I buy a 95 strike call, say for $6, $600 a contract to control that, $100 or $10,000 investment in 100 shares. And I said the stock goes from 100 to 101, and I tell you that the option goes from $6 up to 680. Well, that would be an 80% delta, because that means that the stock moved up a point and my option moved up 80% of that, 80 cents. And of course, the leverage of options means that 6 to 680 move, that's a more than 10%, about a 13% move in that option for a 1% move in the stock. That's a 13 to 1 leverage on the underlying option. Of course, leverage cuts both ways. If you get it wrong and it goes the other direction, you better know how to cut and run on ideas that are not holding the key levels they should hold. Theta is another one. That's the change in value due to time erosion, time decay. Obviously, time is not your friend when you buy options. That's why what I like to do when I'm buying options is I'll usually buy options out on a daily chart play that I might expect to hold 2 to 4 weeks. I'm going to go out to at least a second month option. So right now, for example, we're just about to hit the October expiration tomorrow in the October monthlies. So I've been trading November monthlies for my position traders out 2 to 4 weeks, but this coming Monday, I'm going to be looking out into December options. Giving yourself about 2 months to go before the expiration is usually a pretty good idea for position traders. Vega is, of course, the change in value due to volatility changes. The biggest thing that you got to be careful about with Vega changes is in earnings season. If you've got an earnings trade that you're looking at, better be careful about buying right in front of earnings, because you've got a risk of a big volatility change. Now, gamma is another one. That's how much the delta will change as you get each next 1-point move. So if I tell you that the delta goes from 80 to 85, that gamma would be a difference of 5 for that next point move. So we look at how fast gamma moves. If you want to be more aggressive in option trading, you'll notice that if we're looking at a typical, say, 50 strike call on a stock trading at 50, that's an at-the-money call option. Guess what has the highest gamma? It's an option that has a day left before expiration. For example, today is a day before the expiration. If you were trading something tomorrow morning to tomorrow's close, that would be an at-the-money, say, 50 strike call, and you think that's going to pop up. Well, then basically, you're going to get a big surge in your deltas as it goes from 50 to 51. In this example, deltas would go from about 50% up to about 93% because the gamma is up there at 43. So you can add that for the next point move from 50 to 51. All that means is that as you trade at-the-money options closer and closer to expiration, you're going to tend to see gammas rise. You'll notice that gamma is actually highest, say, 60 days out for a slightly out-of-the-money option like that example in purple there, more like the $49 price level for the stock. Buying a 50 call would probably have about the highest gamma, just slightly out of the money. The chart on the left just shows you the same thing, that these are the at-the-money examples, close expiration, have the highest gammas. Now, we have a portfolio called Option Shark that we use this gamma booster strategy where we're looking for these really strong outlier trend breakouts. A lot of people would say, well, stocks can only trend a minority of the time, and that's true. Any individual stock, it's not going to trend forever. I mean, it's going to have periods where it goes sideways, where it chops around. Our job is to rotate from one stock to the next and find the really strong trend moves among a really fine-tuned list of stocks. Now, we mentioned Bollinger Bands earlier, and one of the things that a Bollinger Band would typically show you, if you look at a 2 deviation band, is it typically about 95% of the time on a 2-deviation band, it's saying that you should see a stock trade within a certain very defined range under the curve. If the stock is currently here at X, that's saying that, okay, it should trade around that, and as it goes further and further out, it's saying that it's less and less likely to get that big of a trend move, more than 2 deviations. But guess what? When you find these unusual Tesla type moves, that's where some of the biggest money in options buying is, because the model does not expect that those big trends can happen either up or like you saw in 2008 on the downside. Some of my biggest profits that I ever had came in the fall of 2008 because the market was not prepared for that kind of a continuing fallout of perpetual downside action that was happening in September and October of 2008. So even stocks like Procter & Gamble and Johnson & Johnson were some of my biggest put gainers because nobody possibly thought that they could get whacked like all the other financial stocks were getting whacked, and yet everything was getting sold baby with the bathwater. That didn't last forever. You and I know that, but there are windows of time where you can take advantage of that when you learn these big trends techniques. So we alluded to it a little bit earlier, but I want to just highlight, I'm really giving you a lot here, and I know it's probably like drinking through a fire hose for some of you, but I'd rather give you more than less. Now, the bottom line is that when we're looking at an option chart, why should I care about an option chart? That's just a derivative of the underlying stock chart, isn't it? But you and I know that options are priced differently than stocks. The bottom line here is that we really have a situation in which there's additional factors that go into an options pricing, and that's, of course, the time erosion element as well as the volatility element that makes the options chart look very different from the stock chart. And yet, most option traders are still out there trying to decipher if they should trade an option by looking at just the stock chart. So my contention is you shouldn't just look at the stock chart. If you trade options, you should also look at the options chart. You know that if you had a stock staying dead flat and just chopping around, if you bought an at the money or an at the money or an out of the money option, those are prone to basically total risk. If a stock doesn't move, the at the money and out of the money option would expire worthless, and you would lose what you put into the trade because of the time decay and because it didn't move like you thought it would. So one of the secrets for me of really helping you to create a more stable base in your option trading is to focus when you buy an option on buying an in the money, an ITM option that typically has a delta of at least 65 to 70%. So that means that, okay, all other things being equal, you're going to keep your time erosion, your theta component down to about a third or less of what you put into the option. So that creates a lot more stable base. Here's a past example. We'll look at a current example here. This was Goldman Sachs earlier in the year. We'd gotten a buy signal on Goldman before all the DC shenanigans last time when we started off 2013 with the fiscal cliff worries, which of course they averted at the 11th hour at the end of 2012. The market gapped up at the start of 13 after having been down from a lot of December, but Goldman had actually rallied in front of that. You can see that it was breaking out here and surging, giving us a buy signal about right around the Christmas holiday, a week before the end of the year, came in for what we call a retest right at the end of the year, and then it launched to start off the new year. We were waiting on that for that kind of confirmation on the hourly chart, which you saw happening there the morning of January 4th as an example, and then the same thing happening on the 15-minute chart that morning of the 4th. So when all those things kicked in, we said, okay, now we can go trade an option, and guess what? The option chart showed the same thing. Breakout happening on the daily chart, breakout happening on the hourly chart, on the middle panel there, and then breakout on the 15-minute chart. And you can see that the option chart is not going to be quite as active as a stock. So you'll see a little bit of sometimes spottiness on some of the option charts, especially for, say, weekly options where they haven't been trading very long. That's why I like to a lot of times look at the options that expire on a monthly basis. For example, we talked to Netflix just a bit ago. If I was looking at the Netflix chart, you can see the big action on Netflix came August 21st until the exit that just happened here earlier in October. If I was looking at the Netflix, for example, October options chart, say the 320 calls, the stock's now 330. If you're looking at the 320 calls, you'll notice that, gee, it actually looks kind of choppy on that daily options chart. Wouldn't have really inspired me to trade that on the daily basis. Now, maybe I could have picked something up on an hourly chart. You can see where there was one little window back here the 1st of October where it set up and broke out at about $10, $10.89 to be exact, and then it ran up into the next day to about 19 bucks before it gave the exit here the following day at about 12.25 to be exact. Just following the percent R through there. We don't have enough data to go back and really say, okay, that you could have, seen the buys show up on the option chart itself. That's what we usually like to see. IBM's another one, for example. IBM had a negative reaction to earnings today, and you say, well, gee, did the put option chart tell you anything? Tried to give a sell and then got stopped out here about a week and a half ago with that rally back that the markets had into this latest round of debt ceiling talks. Now, bottom line is, if I was looking at the put option chart for IBM, say you were looking at the 185 put, which was near the money coming into this action, you can see wasn't quite there. We didn't quite give us the confirmation we wanted there about a week and a half ago. If it had followed through above that high on that option at 785, then it would have really been into breakout mode. You can see IBM's been very choppy here. It's tried and failed a few different times here to break out. Even today, same thing, not breaking out. And bottom line is that if it closed above 12.25 tomorrow, that would actually be a bear signal for IBM being worth buying into the puts, and we would then probably go look at a further strike below that wouldn't be quite so expensive. We don't usually like to buy options more than $10. Now, where do you find option charts? Asked John M. A lot of the broker platforms have them. This is TradeStation, Thinkorswim, Options Express, Trade Monster. They all have them. So that's really useful to you, and you can take advantage of that. Now, I know we're about maybe 20 minutes away from me needing to jump off, so I'm going to just mention, before I go into a few other analysis examples, how can you start learning some of these tools right now? Well, you can go to this special page we set up for you here tonight, and it's bigtrends.com/TradeSecrets. So I am going to type it in there just so people have that in front of them. You don't have to go jump there right now. You can jump there a little bit later. Just make a note of it. bigtrends.com/TradeSecrets. This is actually 3 different DVDs that I've done over the years that show some of my top indicators like percent R, acceleration bands, and a whole lot more. And when you go to that page, you'll see it's a real library of information. Each of these DVDs is well worth more than $49, but actually we're giving you all 3 of them here today for $49 total. So you can see, you can click on the individual ones too if you wanted to buy any one for just 25 bucks, but you get all 3 for just 49 bucks when you hit that add to cart button. This includes how you can learn systematic trading with options, and you start to understand the key rules to develop a winning trading system. Then the high impact option trading really goes into the whole basis of acceleration bands, why I love that indicator so much, and then the other rules that I use around that. And then the 7 golden rules for options trading success goes through really a lot of the psychology of trading, the emotions of trading, the top problems that all traders face, and how you can get around that with the 7 golden rules. So you just hit the add to cart button when you get a chance later on. I know we got a lot of other speakers you want to catch. If you're in the U.S., by the way, of course, you don't have to pay any shipping, and the bottom line is that even overseas, it's a minimal shipping charge of $14.95. But it's free shipping in the USA, 49 bucks, all 3 DVDs. That's not each one. It's all 3 packaged together for just 49 bucks. You're getting 5+ hours of education from me for basically less than 10 bucks an hour when you break it down like that, okay? So go to that page, bigtrends.com/TradeSecrets, and you'll see some of the best stuff out there. Now, for me, it is about making sure that you're focused on, really making your buy and sell rules very simple and easy to execute. I find a lot of traders who are over-analyzing the data, and then they're not pulling the trigger when they need to. When it says sell, like I said before, when it's an exit signal, to get out and then ask questions later. We have our buy and sell rules coded across a variety of different trade platforms, so you can actually get that automated. Now, the automation for me comes where I go and test And this is an example on Apple going back over about 20 years of data from 92 to 2012 as an example. Where you say, okay, you go and look at Apple over those 20 years on the percentile system, and you say, well, how would you have done, right? And you say, okay, well, looking at that history, you can see, of course, you wanted to be long, not short. Obviously, it would have lost a little bit on the short signals, but the bottom line is that the money was in being long on Apple. And we'll look at a lot of different key things when we go and do our system testing. So we're looking at, I'm just showing an example here on that particular one. You can see that we'll look at things like the performance history for Apple. So you can go in and look at the equity curve. So you can see that the action on Apple has really taken off since 2005 on the daily system. You can see that it really wasn't that profitable going back into the 90s and into even the mid 2000s. The money on Apple happened when the stock really started to move there at the end of 2005, beginning of 2006. And you can see all those green dots mean it was making new equity curve highs for that period. And you can see since the November signal was about the last peak in the equity curve into November, it's actually been down a little bit. And you can see why, because short signals have not worked on Apple. Even though our long trades are still holding their profit, it's taken a few more shorts that basically some of those worked and some of those didn't over the last year compared to where we were here before. So you can see if we went and looked at the stock for a second, show you the system that it's actually trading. You can see had a good winning trade on the long side on that last one. We're now in another long trade. But you can see some of these shorts got off to a good start, and then it would give up the profit by the time it came in and exit. That's why another rule of thumb for traders is book partial profits and then tighten your stops on the rest. You can see that was a great short signal back there in October last year on the way down into mid-November. It dropped 100 points, but by the time it gave the exit, it had given back half of those profits. Got one short that stopped you out quickly for about a 40-point loss the next day. So, that's where it's hurting on that particular system. The shorts haven't been as good as the longs on Apple, at least. So, that's something to be aware of. And you say, okay, so then maybe I want to trade shorts a little bit lighter than I trade longs. Now, in the DVD special, we're talking about not just individual stocks, but really a lot of other key components that go into market timing. I promised you a quick little look, for example, at the E-minis. You could use this same analysis if you typed in the E-mini ESZ13, for example. I love to look at charts just like you do. Now, the daily on the E-mini obviously is going to show you one thing, but I would say this is where you go in and look at a 60-minute or even a shorter term like a 15-minute chart. And you can see, look at that, the 15-minute chart this morning gave us a buy on the E-mini at 17.13 and a quarter, and basically rode it. We had one retest here intraday. You could have gotten back on and you would have tightened your stop there at 17.20 and 3/4. Didn't close below that, and then it blasted off into the end of the day. So the bottom line is that this was a nice trend signal, and you can see even on short signals when they're not really that profitable, 17.10 short stops you out at 17.09 and a quarter. You still made a buck on that one. So it'll still keep ratcheting your stop after you get that initial surge. So the bottom line is once you get that initial bit of profit in your favor, you can really make that work for you. Now, so that's an example of the E-minis, how you can trend trade even intraday. This also shares with you my favorite ETF systems, the top technical indicators, and really what I think are the best option strategies for any market. And then you can always ask me if you have questions as a buyer here from Big Trends. You can drop us a note, and either myself or one of my analysts will get back with you with making sure that you're following the rules correctly. Now, a quick note about earnings season. We're in it right now, and the bottom line is that we noted that you've got to be careful about volatility spikes in front of earnings. Now, I mentioned that I wanted to just have a quick little look at Google here, and you say, okay, we look at this, and we'll try to go ahead and get to a few questions before we're done too. I will do my best. But this was interesting. You saw Google had a big surge, and I mentioned to one of my analysts, I said, hey, we have a situation here in which Google looks like it's a cheap straddle here right in front of earnings. Look at the earnings. We go in. Hold on one sec. Let's pop it up to the options. Google's interesting because they always seem to come out the night before the final expiration of the options. And we had finished just under 890. So I was mentioning to one of my analysts, I said, hey, this is a cheap straddle right here. Google is on the call. If you bought a call and a put that's going to expire tomorrow, it's got a day left. You say, well, that's crazy. Well, this is the best estimate of what the market was saying this option, the movement of Google should be heading into tomorrow. So just under 16 bucks and just under 19 bucks. It was at about 33. It actually went up a little bit right before the close. It was trading right at 33 at about 15 minutes before the close. It finished actually at about 34 and a half. So let's just even call it 35 for a round number. If you say 35 bucks on 890, you'd be basically saying that the market is saying that Google should trade up to about $925 on the upside, or down about 35 bucks, down to about 855. So if you bought the straddle, buying the call and the put, if you get a move over 925 or a move under 855, you make money tomorrow during the trading. Well, guess what? You see where it is after hours. We're at 961. So essentially, if you had an 890 call and put, your 890 call, of course, your put's not going to be worth anything, but your call will be worth what? It'd be worth over $70. So if you paid, in this case, 35, you'd basically be doubling your money on the straddle overnight, okay, as an example. That was a fairly cheap option. So that's a good way to know what the market expects, looking at the at-the-money call and put coming into the earnings, especially right before the expiration like that. So now my view is that, if you're going to trade, you've got to trade the right option. I think trading in the money options is a much saner and safer strategy than trading out of the money. Earnings can be a trend catalyst. So if we get that follow-through %R move, then we would definitely take advantage of that and jump on it after that news hits. The only time where I think you should consider holding in front of the earnings report is when. It's when you actually have a profit in your total position where you can get all of your risk capital back out and have a contractor more left over after you've gotten your risk capital back out. So for example, if you doubled your money coming in front of the earnings, you could sell half of your position and then ride the other half. If you only had a 50% gain coming in, you could sell 2/3 of your position, keep a third on. But get your risk capital back out of that trade. It'll make for a lot more sensible trading. We know that earnings season only happens four times a year, and you have to be prepared for that volatility. You just have to know how to manage it. I believe that you don't want to play the game holding it in front of earnings unless you get your risk capital out. And so we want to trade when the odds are in your favor. And so for us, when you see increased volatility, we would tend to be selling that premium. If you had a position on, you could hedge it by selling another position against it. And then you can use the technicals here to give you that edge. When you line up the time frames, it's not just looking at the daily chart or the hourly chart or the 15-minute chart. For me, it's lining up those time frames. The more those time frames I get in sync, the more I can take advantage of this. So now I'm going to go back and answer a few questions. I've only got a few minutes left here before we go on to our next presenter here at 1/4 in 10 minutes. So let me go back and just see what other questions we had that I might have missed. So Igor says, could you fix your profit by shorting the stock? You could, but you need to make sure, say you're long the stock and you want to sell some stock against it. If you're thinking about tax considerations, and especially towards the end of the year, you need to check with your tax advisor, because, and it's the same way with selling a covered call, you can't sell it too far in the money or else the IRS considers that you've already basically taken all the risk out of that position. And so make sure you understand what's the right type of a spread or option to sell, or typically shorting against the box, the IRS is going to say you've effectively pre-sold that in this tax year. So remember that, because that saved me a number of times where I had a big gain. I wanted to carry that into the next tax year, but you can't sell an option too far in the money or the IRS will consider that you pre-sold the stock or the bull position. So that's a real eye-opener for a lot of people that haven't considered that. We talked about option charts. They're on a lot of platforms. Now, bottom line is that, I know that they're recording this, so you will be able to go back and re-review this. Also, you can drop us a line through clientcare@bigtrends.com if you have any questions about any of the big trends indicators. Now, that IBM trade Taz asked me about, I would have stayed away from it, even though it did popped down because it didn't confirm quite like I wanted to. You know, it does take institutions a long time to buy their positions, so that's why these trends, in my opinion, tend to last. So Leon says, you know, if the market only trends 20% of the time, how are we going to make a gain? It's because you're going to rotate. I'm glad you mentioned that, Leon, because I forgot to mention one other thing here. We're going to rotate our capital. I use tools like TradeStation's radar screen to go literally sort through. This is a daily chart example, and I'll go sort through hundreds of different names to say what are the strongest and weakest names on the board. So I can quickly get an overview of what CCI and %R and other tools show me are the strongest stocks on the board. So then I'll start going through and literally clicking through each of these and saying, okay, well, let's look at FedEx real quick across all 3 time frames. Let's look at SanDisk real quick. And you can see FedEx obviously just confirmed on the daily this morning, but it was already there on the hourly, and then the 15-minute confirmed. So it was a triple confirm at 123.88 here intraday with a 15-minute coming on last. Okay, so you can go through and you can say, okay, are all those time frames backing me up? You know, SanDisk was already bullish on the daily back here a few weeks ago. Then the hourly went confirmed, and then on this latest move, the 15-minute confirmed this morning here at 66.63. So it picked up a couple points here if you're paying attention to all those time frames. And you can do the same thing when you flip it over. So you say, well, if we flip it on the downside, now most of the downside examples are going to be the inverse ETFs, for example, but if we flip it over, we mentioned IBM already, then some of the inverse ETFs, and then you might say, well, what about even a name like eBay, which had a disappointing reaction to earnings here? You can see, well, it's not confirmed yet on the daily chart. I would be waiting on that one. Even though the hourly and the 15-minute looked pretty good, I would be saying pass because the daily didn't validate what I was looking for. United Healthcare, another one that had a miss on earnings today. So, UNH setting up here today, if it follows through under today's low, this one could have some more downside potential. So you start to build your list of bull and bear candidates, and obviously we've had a lot more bull than bear candidates of late. So, the bottom line is that, any of these names you're looking at, you can go through and go find the biggest and best opportunities this way. So, okay, let me make sure I've answered all the questions here. What about selling puts on VXX? Yeah, I mean, there's definitely, VXX has a trend bias to the downside, right? That's the volatility index ETF, the short-term version. And you can see, this is interesting because right back here, I told my Big Trends followers, we had a record amount of CBOE VIX options traded back there on the 8th. People were getting really worried. They were buying a lot of VIX options, betting that volatility was going to surge. Was that a good call? Well, no. %R was overbought. It was not falling through, and you can see what happened. We shot right back down. Obviously, very choppy right now. I would say, looking at this, we actually shot and then we broke down on the VIX. That's a nice confirmation for the bulls when you get bear trends in the VXX. You can see, looking back in time, the last one didn't work, but the one before that was a nice trend in July into mid-August. So this could be the start of a bull trend that could last, looking back at this VIX sell signal that'll be in effect at today's close or officially tomorrow's open. So yes, you could sell puts on the VXX, or you could actually sell options in general on VXX, even like doing call credit spreads, betting that it's got this inherently downtrending bias to the VXX. Will Google follow through the upside? Well, again, my opinion is not what matters. What matters is what happens after this gap that happens tomorrow. You can see it was going overbought and then it was kind of failing, so it's going to gap up to 960 or whatever it gaps tomorrow, and then the question is, where does it go from there? So bottom line is that we will be waiting for that follow through rather than chasing it tomorrow morning. We would not be chasing it. In fact, I would say if you had anything on, I would book some windfall profits, and then you can always get back on board the horse once you get the confirmation signal. Okay. As I said, when you go to this page, bigtrends.com/TradeSecrets, I'm a top-down guy. You probably gathered that. I start with the big picture on the market, then I go down to the best stocks, and then I find what are the appropriate options to trade on those stocks. I don't try to go through thousands of option symbols and say, this option is undervalued. An undervalued call is going to be a call on an uptrending stock. An undervalued put is going to be buying a put on a downtrending stock. So if you see a stock that's collapsing, like say JCPenney is an example of one that's been breaking down here lately, right? I mean, basically, if you look at JCP, you say, well, gee, look at the last signal. It went bear confirmed here when %R broke down and then followed through here. 1190 gave the short on the next bar's open. 1162. That stock's been cut in half in less than a month, since late September. So even a very conservative option buyer, say you were looking at the JCPenney October 14 puts even. You said, well, even from that period, you see where it opened right there at about 289, and now it's sitting here at 660. I mean, it's more than doubled on obviously the stock's gotten cut in half. So it's not great leverage because we're not saying that's the most aggressive option choice. But there's always a bull market and a bear market somewhere. Your job is to find it. The scans help us to do that. That's just another offering that we offer from Big Trends. So make sure to make a note of that page, bigtrends.com/TradeSecrets. It's shown at the bottom there. TradeSecrets, nothing fancy about that. But what's fancy about it is that when you go to it, you'll see each of the 3 DVDs give you a wealth of knowledge, a wealth of learning. And so, I've been able to be with you for an hour and 15 minutes. If hopefully you got even one key idea about trend following and how to start to get on board the right kind of names, then that can help you to be a breakthrough. What I would say is of all the things I share with you, take the %R indicator, look at it. You got to make sure you're looking at the right time frame and basically saying, okay, could you have ridden the trend better? Go back and look at the ones that got away from you, the ones you missed, the ones you could have been riding, and saying, yeah, not all of them are going to work. Some are going to stop you out quickly and you're going to get out of those, and others are going to ride and you're going to be able to be a part of some very meaningful trends. So from this perspective, that page at the Trade Secrets library, bigtrends.com/TradeSecrets, I'm going to paste it one more time in here so you can make sure to go to it, that you'll really see that this is really taking literally years of my life and condensing it down into a few hours that you can really benefit from the Big Trends way. So go to that page, bigtrends.com/TradeSecrets, and then the buy and sell signals on a chart automatically, JT, comes later. This is more of the education piece. Okay, you got to be educated first and understand how to do it to then want to get the buy and sells. We do offer that as a separate add-on through several different key platforms, what we call our Big Trends Toolkit, once you soak in the DVD training. So do the education piece first. I know you're eager to find new trade examples through tools like the radar screen. I understand that. But go to the bigtrends.com/TradeSecrets to get the education sent out to you. Remember, when you go to that page, it is just click on that link at the bottom. That's the Add to Cart button. That'll pop it in right away to your cart. I've already got it in there, but just click if you're in the U.S., if you got a valid U.S. ship code, your shipping will be free in the U.S. Even overseas, it's only $14.95, which barely covers our cost and the time to get it out to you. But bottom line is that that's what we're here for, to help educate you first and then help you be more effective from there. I'm out of time, and they're all helpful if you're just learning options, Jimmy. Absolutely. You'll really get a real core foundation in addition to learning a lot of key principles you're not going to learn anywhere else. So I've got to run. I'm going to hand it back over to Yana now and say thank you for being with us. There's lots more to come. So make sure you keep on soaking in a lot of great training education as part of this awesome series here through Trading Pub. Yana, I'll hand it back to you now.
Thank you, Bryce. Awesome presentation. Thank you so much for sharing all this information with us. I'm sure that all traders were able to learn a lot, and we really appreciate everything. I see that our next presenter is online. He's Ross Givens from Blue Tick Research, and he's been with us in the past, so I know that he has always brought great content, and you guys are going to learn a lot from him. So here to share some of his approach to trading futures is Ross.